The good thing if you're a buyer right now, bad thing if you're a seller in a big city, is so many cities that I love that actually did really, really well in the last couple of years had an overdevelopment of new units come online, Michael, like in Houston and in Dallas where I invest. And the fact that there are so many units competing for the same renters means there are very motivated sellers of new properties that need to sell to get out of their loan.
Alrighty, folks, we're going to have a conversation with an amazing investor, somebody who's been doing this just as long as myself, but we're going to have a unique conversation. We're going to ask, what if Anna Kelly believed with every fiber of her being that a housing crash has started, the housing crash will roll on for the next 18 months, and ultimately result in at least a 20% reduction in price? Why are we having this conversation? The reason I want to have this conversation is many of you out there believe that a crash is coming. I believe that many of you will be doing nothing. I know one thing for certain. If Anna believed this and she thought it would take 18 months to get there, she is not sitting on her butt and doing nothing, waiting for some bell to ring in 18 months. So we're going to find out what the heck she'd be doing. All right, Anna, what's going on? 20% crash coming. You believe it. You're going to invest like it. You think it takes 18 months. What are you doing today and over the next 18 months?
The first thing I'm doing is getting the most important question right. And that is, what are your financial goals over the next 18 months and over the next 5 years? So if your main priority for your financial goals, and I'm putting on my old private banking hat, is income, then you go look for deals that cash flow today, that if values crash, it doesn't matter as long as you're cash flowing, right? If your number one financial goal is appreciation, you got to be a lot more careful, because it means if you think there's going to be 20% depreciation, then you're not going to buy anything unless you can get it at least 20% off of the value today. And you're going to be really careful about location to make sure that what you do buy, you buy in a location that's going to rebound more quickly and have that appreciation if you're a long-term hold buyer. If you're looking for short-term appreciation and trying to flip properties, I tell you, it's going to be real hard. So you might want to reconsider your strategy right now. And if you're in asset preservation mode, you also don't want to lose too much value. But if you've got a long time horizon, then you go look for big discounts today. You create your 20% reduction on the buy and you buy it right. And so I would be looking for deals, absolutely, looking at your number one financial goals, and only do deals that meet those goals and will allow you to have a 20% haircut in case it went even further than the 20% discount that you're trying to get today.
I love this advice, because this is what I was hoping I would get from pros like yourself. It's like, okay, if I believed it, I'd be doing the work today. I think there's a lot of people, and I see them in my comments. It's like, oh, falling knife, oh, this, oh, that. It's like, guys, you said the same thing in 08 and 09 and 10, and you missed it. If you believe a 20% discount is coming, write the offers today, at least 20% off. Shoot, go for 25. If you believe it in every fiber of your body, go get that discount today, because the reason you want to do it today, in my opinion, is everybody is scared. Right? They're nervous. They're uncertain. I don't know what people get. Why do people keep following the masses, Anna? I just don't get it. The masses are broke. If you keep doing what the masses are doing, you're going to stay broke. I want to be aggressive when others are scared. And if I believe at 20, I write the offer today, right?
Absolutely. And this is part of human psychology. And it's the biggest risk in investing. It's that you panic and sell at the wrong time, and you don't take the opportunity to buy at the right time. And the issue is most people think the right time for either is what the masses are doing. And, Warren Buffett's very famous for the quote, be greedy when others are fearful and be fearful when others are greedy. And there's a lot of truth to that. And you look at the psychology of emotions. I've done some talks on this where you look at, the peaks and the valleys of the business cycle, of the real estate cycle. At the peak, when everybody looks like a rock star and when the economy is starting to get overheated, that's actually the maximum point of risk and pain for you to buy at the top of the market. When things are falling, when everybody's afraid, when prices are starting to stagnate and some of the investors disappear, they're not patient or they're afraid, that's actually your maximum point of opportunity. But you have to fight every part of your emotions that say fear, fear, fear. This is the danger time. When, they also say, run in when there's blood on the streets. I mean, we're not yet at the maximum point of pain, in my opinion. So I think we'll get even better deals if that type of crash really did happen. But just like the advice to dollar cost average into the stock market, right? May not be wise to do it at all-time highs, like everybody's still running in today at all-time highs when the market has a lot to correct as well. But they look at real estate like it's somehow more risky than the markets. And the reality is, as we have seen over the last couple of years, Michael, is real estate cycles are very, very slow. They don't crash overnight. It's we've been in a real estate transaction recession for 2 years, right?
Yeah,
We're just
at
starting
least.
to see the pain of that the real pain in commercial, in new housing construction, all of that starting to slow, supplies starting to tick up. So, these things can last a really long time. So if I thought it would fall another 20%, guess what always happens eventually? The first thing to go in recession is always real estate. And the first thing to come out is always real estate. So you have to think about the fundamentals of investing, sell high, buy low. It's really that easy. And then it's location, and a long-term time horizon. When you're in these shifts, you think a bottom is coming. You have to invest with a long-term mindset, not, oh my goodness, I'm going to do this deal and it's going to lose 20% next year, so I'm an idiot for buying it. Well, what about in 5 years? And what about in 10 years? Recession is short-lived. They're usually 10 to 18 months. You got 2 years to recover. And then it's an expansion if history repeats itself. So, you've got to understand the psychology of investing, the psychology of fear, and you got to be willing to run into the fire. Both you and I made significant wealth because we ran in when everybody was running out in the GFC. And so wealth is made at the bottom. It's made on the buying it right at the right price, and then holding long term, which is when you get that bounce back and that appreciation.
Yeah, and again, I think the other thing that I would tell people to do in this environment, if you're looking for a 20% correction, again, and let me be clear, I'll say it here, I do not think this is going to happen, but this is a fun exercise, right? What would you do if you did believe it? The other thing I would tell people is I would actually upgrade what I'm looking at, right? Today in this environment, you're probably looking at older homes, probably 3-bedroom, 1-bath, the older stuff. I might actually go up in quality. One of the things that I saw in the last cycle is kind of everybody took haircuts, but what you saw is that you could get better quality, which had better rents and better long-term appreciation. Because your point is very valid. It might all come down together, but let me tell you this, a Class A, Class B property, when it turns, it will turn much faster than Class C.
Absolutely. And history proves that out, Michael. History proves that out.
Yeah.
I've done a lot of research on this because I have a lot of properties, right? Both small and larger properties. And we're always looking at, okay, where do we think the market is going? When's a good time to buy and sell? Where are cap rates going to be? And if you look at history, anytime that there's been a major correction in real estate, 2008-9, a couple years after that, you go back to the 1970s and 1980s, the savings and loan crisis. What bounces back for sure and adjusts in price is Class A, and then Class B, and then Class C. It's big cities, and then mid-sized cities, and then small cities. And why is that? It makes a lot of sense. Where is the most value in a property? It's something that's newer. It's something in an area where you're always going to have it filled with tenants that are good quality, good paying tenants that survive through the recession, that generally have savings, that are faithful to keep paying their rent. And so the big institutional buyers, what do they do in times like this? They're not running away. They go buy. And what do they buy? They buy Class A in nice cities, because they know that those areas are going to be more resilient than the rest of the country. Because let's put it very clearly, if there's a real estate crash, it's because there's an economic crash, right? It means the whole economy is in the dumps, is in the dumpsters, worse than it is today. And so what that means is that some area of the economy has to be that stimulus that gets you out of the recession. And it's generally areas like big cities that have higher value employers that are paying their people more, in a diverse group of employers in big cities. And so institutions are doing what you need to do. Look in bigger cities or the suburbs of bigger cities. Don't chase yield thinking, oh, I can get a great deal in a podunk town, as we say in Texas, that or a one-horse town with a stoplight. That area is not going to bounce back. So it's all about asset quality. And to your point about buying up, those investors who have properties and are looking for more properties you can hold long term, you want to buy those that are from motivated sellers. And the good thing if you're a buyer right now, bad thing if you're a seller in a big city, is so many cities that I love that actually did really, really well in the last couple of years had an overdevelopment of new units come online, Michael, like in Houston and in Dallas where I invest. And the fact that there are so many units competing for the same renters means there are very motivated sellers of new properties that need to sell to get out of their loans. And so for someone like us that has the liquidity, you've got some investors, you can partner up, taking an opportunity to go buy a newer quality asset at a limited time in history when those asset holders, those builders are distressed, that's when you get great quality assets that any other time during a good expanding economy, they're going to be the least motivated to sell to you for a deal. Right now, there's motivation where there's oversupply for sure.
Yeah, the other thing I always think about is, again, we're assuming here that you think, or we in this scenario, 20% crash over 18 months. And the other thing I think about is, okay, what happens if? What do I mean by that? Well, let's just say this is happening. The forces around us will react. If the median home price around the country falls 20%, the Federal Reserve is going to be whacking rates aggressively, perhaps back to zero. The government will be performing some kind of stimulus. And probably most important, which is very different than the GFC, you will once again have websites on your mortgage owners saying, would you like a 90-day forbearance? Click here. So this epic crash in REOs and short sales just will not happen quickly. It might happen if we're down long enough, but they will do everything they can to put out this little fire and get the system working again. Don't you think?
Absolutely. They do. They have to, right? Because if the whole economy gets that bad where we have let's say a repeat of the GFC, because there's some people that are going to say it's going to be just as bad as the GFC.
Anna, people are saying to me in my comments, the GFC was the warm up. This is going to be bigger. Yeah. I'm like, you guys just don't get it.
Yeah. I don't believe they're right. We watch this often.
You're so kind. You're so kind.
I'm trying to be right, but let's say here's the other side of the coin. We always have to ask ourselves what if. And so this is a really good exercise. This isn't just like, oh, let's play a game, right? I'm thinking about it. Some 80s movie. Shall we play a game? I don't remember what it was called, but sorry. I'm a kid of some wargaming show. But it is really important to the point of what wargaming. What do our governments do? They anticipate what if we're attacked by Russia or attacked by China or China goes after Taiwan. They play war games and they do it for real. And they send their tankers out to play these games because they want to say, are we prepared for what we don't see in the worst case? So let's just say we have another pandemic. Let's say China goes after Taiwan. Let's say Russia upregulates their war against Ukraine and we are in all-out war. Could real estate and everything else crash 20%? Absolutely. Absolutely. And if it does, are you going to be afraid or are you going to take advantage of the opportunity at the bottom? So you got to be prepared for the bad because bad could be good for you as an investor. And then you have to figure out, okay, how do I protect and preserve what I have? And then what I can afford to lose or lock up for a really long period of time, because you have to have that long time horizon. Again, that's when you go after those assets. So it's important to say, yeah, it could, nothing would surprise me anymore. We've lived through an era of lots of exogenous shocks to the system that have had impacts on all of us, to put it lightly, financially. All of the money printing through the shock of, COVID allowed us to not experience the depths of the GFC for very long because the government, and I say this in air quotes, gets better, air quotes, at getting us out of these crises, but they do it by, to your point, drastically slashing interest rates, drastically money printing. Now we saw, and you alluded to this, saying, hey, let's give people forbearances, tack their payment on the back end. Don't let us have these mass foreclosures and short sales like we did. So the government will write in to try to rescue the system. And again, that's why you have such an opportunity at the bottom. It's not just that prices fall, it's that you can scoop up prices cheap, and you can lock in the lowest interest rates that you've seen in several years and lock those in for a long period of time. That's when real estate really becomes an ideal investment, because you've got the income, the tax benefits, which look like they're going to go through as well. You've got the equity from buying right. You've got some slow appreciation over the long term, but you've also got that leverage that's paying down your principal every single month. And so real estate is a great thing to buy if there is a crash. And as long as you have good debt on your properties and they're in good locations with good tenant quality paying rent, your real estate at that time is going to be more resilient than many, many other investments that are all going to go down at the same time. And just remember, what comes out of recession first? It's real estate. It's where you're going to see the first part of the recession, and then you're going to see it bounce back, and it's going to bounce back with a vengeance. So if we have a crash, I'm excited. I will buy more, better quality assets in better locations. But today, I'm going to make sure I don't pay retail for anything. I'm going to get a great deal on the buy, at least 20% off, put some good financing on it without long prepay penalties on it, so I can refi when those rates fall. And it's a good time to be an investor, whether real estate crashes or not, as long as you have that long-term time horizon.
Yeah, you brought up there's kind of two more points on this and we'll wrap this up. The other thing that I think both you and I would do is we'd be going through our existing portfolio, looking at debt structures that we could simply refi, right?
Yes.
We probably wouldn't be, we may take cash out, but probably not. We just do some rate and term refis. So it's very likely, again, 20% crash, 18 months, the Federal Reserve does what it does all the time, takes rates to zero. Investors who own assets, we're going to refi, re-term out the loan to 30 years, and our cash flow will probably go up 15, 20% by signing some papers.
Yeah, or at least not go down 15, 20, 40%, right? I'm in a very real situation, like a lot of investors who have assets, where we have commercial loans where rates reset for 5 years. I took advantage of those low rates post-COVID, locked them in for 5 years, should have in hindsight locked for 7 or 10, at the minimum, but locked for 5. And I have rates that if we don't have the crash and we don't have rate slash, my payments will go up on my mortgage. My cash flow will come down. So I've already been doing that work. And if you haven't, you got to do it now. Look at it. But yes, if your rates, if things are status quo, rates could go higher, right? And then your income could be slashed. If we have a correction, that is the time. It's the only time for probably a decade or so that you're going to see low rates again. So you've got to take advantage, break the prepay penalties, whatever you got to do. If you can lock rates in again at 3 to 4, 5% and lock those things for 10 years plus, you're going to be doing really, really well. And that frees up more cash flow that you can then go and take advantage of buying opportunities when they are on sale, for sure.
I love that. And then the last topic I want to close on is I want to get to kind of the tippity top tier 1 class A kind of short-term rentals out here. I'm talking oceanfront properties. I think it's really interesting to think about because, again, you've shared on this channel that you own several of these. You also shared that you were looking to sell one at one time. You took it off the market because the market's not there. I'm going to imagine, if the general real estate market goes down 20%, some of these Airbnb, tier 1 assets, they might go down 40 or 50%. I think it's some number on as a buyer of even that stuff.
Yeah. I'll give you a perfect example, Michael, and this is just how I think as an investor. And listen, you make bets and sometimes they pay off and sometimes they don't. And sometimes it takes longer to pay off than you think it will. But this is what I thought. A couple years ago, I bought 2 oceanfront properties in Florida. They were doing amazing. The rentals were doing amazing. One of them I bought for selfish reasons. I want to live there when I retire. Well, I'm retired, but when my kids are out of the house in 4 years, I'm going to live on the ocean on the Emerald Coast of Florida. So I bought one today that, makes over $100,000 a year, completely managed, hands off, and it's taken care of beautifully. I locked in a rate at about 4% for 30 years. I bought it about $100,000 below what its value was at the time. It's already gone up about $300,000. But with it has gone up my taxes and my insurance significantly, which reduces the cash flow. That property we're keeping long-term. I'll never sell it. At least that's what I think today. Then I bought a condo in Perdido Key, Florida. Why did I buy the condo in 2022, knowing that short-term rentals were getting a little overheated, knowing that interest rates were rising, knowing that potentially values and income could fall for a while? I bought it because there had been a major hurricane come through, Michael, and it was shut down for a year. And then COVID hit and it was shut down for a year. So rental income in that area had been really depressed for 2 years, which brought properties down. I bought the condo for $200,000 less than the exact same condo, same builder, about 30 miles away. And all the other condos like it were in the 800,000 range. I bought mine in the 600 because I knew even if values fall and renters don't come, if I'm buying it 200,000 below its value and what it was 2 years before, I knew I had room to go up the 200, even if values fell a little bit. And so I put it on the market to sell to see if I could sell it at its peak. And guess what? Interest rates didn't allow it to cash flow for the new buyer. It didn't sell. I pulled it off the market and I'm keeping it. And so you've got to invest with that long-term horizon that says you make money on the buy. There's going to be seasons with short-term rentals. You're going to have seasons where people can travel. But guess what? In a recession or a white collar recession like we've been in for most of the, most people are going to stop traveling. Your income's going to fall. Taxes and insurance could go up. Rates could go up. Your values could fall. But I don't care because it's still at least breaking even. I got great debt on it for the long term. I know I have intrinsic value where you can't build them for what they are today. And I'll hold it for 30 years if I need to. And guess what? This summer, I'm rocking it. I'm almost completely booked, making great income because I bought oceanfront, Michael, which you have to think when people do travel, who's going to pay for travel? It's the people that have the money, even in a recession. And what are they going to want? They're going to want on the ocean, not a few blocks away. So, that was my long-term strategy that, there's going to be blips in the economy. My value could fall, the income could fall, but I've got something with intrinsic value that is oceanfront on the sand. And over time, it's going to be worth a lot of money and I'm going to get a lot of rental income on it. So it could be a great time, Michael, a great time. And this isn't just, I'm not trying to sell stuff. We see some of the comments like the crash, but then they're like, you guys are trying to sell real estate. We're not realtors. We're not trying to sell real estate.
Not at all. Yeah.
We're telling you how to be a wise investor. But here's the reality is that when values fall, when you have motivated sellers, that's when you want to be going in and you want to find who's motivated. And to your point about vacation rentals, there is almost no more motivated group other than commercial real estate and maybe some single family new home construction builders than vacation rental owners who did not make good decisions on what they bought and when, who needed that rental income. There is a huge amount of supply in Florida condos and Florida neighborhoods and Tennessee and these short-term rental markets where the sellers are so motivated to sell. They're stuck that if you go in today and solve their problem, you can get 20% off of some of those properties. And you just have to be doing the right deal, hold it long-term, and then you'll reap the rewards on the other side of it. I'm actually looking, there's some condos in my building for sale. The one I just told you about. The prices are dropping such that I'm like 50 grand further drop on one of them. I'm going to buy a second one in that building where I wanted to sell it because
that is exactly what I knew that was coming. Because at some point you go from a seller to like, this is too cheap. I'm going to buy another one. I knew that was coming. Yeah. I love it.
I'm price match. I'm price watching. I'm price drop watching. I'm like, nah, not there, but I'm getting close.
Getting close. There you go. Anna, where can people find you?
Great. You can find me on Facebook at Anna Kelly, REI Mom. You can find me on your show and you can find me on my website if you're looking for real estate and wealth coaching or consulting at AnnaKellyInvesting.com.
Thank you so much.